8. Financial stability is fundamental to price stability and growth. That is the core principle which we follow. 9. The external sector is eminently manageable. Thank you.
Thank you, sir, for those opening remarks. I'll begin the press conference by inviting Mr. Anup Roy from Bloomberg to ask his question.
Thank you, sir. Sir, this is regarding the OMO announcement that you did. So will there be a calendar for OMO, and is this in preparation for the JPM bond index inclusion?
As I have said in my statement that first thing I would like to say that it has nothing to do with the bond index inclusion. And let me reiterate that it has nothing to do with bond index inclusion. It's a part of our domestic liquidity management. With regard to calendar, I have said that we will watch the evolving trends. There are several moving parts in the whole liquidity scenario. We will watch the evolving trends and we will notify as and when it becomes necessary.
Thank you, sir.
So we do not at the moment propose to give a calendar.
Thank you, sir. I'll move on to Mr. Manojit Saha from Business Standard.
Good afternoon, sir. You have said that the transmission is still not complete, while saying that the stance is withdrawal of accommodation that is maintained. So do you expect banks, does RBI expect banks to further adjust their rates so that transmission is complete? And are you worried that a change to a neutral stance will dilute your resolve, will signal a dilution of your resolve to act on inflation?
You see, a change of stance to neutral will be on table when the situation becomes so. At the moment, the monetary policy, the rate hike is still incomplete. I have given the numbers in my statement. We have increased the repo rate by 50 basis points, but it has not fully translated to either the deposit rates or the lending rates of the bank. There is still some distance to be covered. So we would expect that to, align with the increase in the repo rate. And so therefore, at the moment, the stance remains withdrawal of accommodation.
But why OMO sales when liquidity is already in deficit? Do you expect the deficit? I mean, you have a figure in mind what kind of deficit you want to?
Okay, I would request everyone to just stick to one question. So, you see, liquidity is not in deficit. The liquidity over the last 2 or 3 weeks went into a deficit mode mainly because of advance tax payments and GST payments. So therefore, what was a part of liquidity went as payments for GST and payments of advance tax last month in September. Advance tax was in the middle of September and GST was around 20th of September. So therefore, for those 2-3 weeks, the liquidity became very tight. But overall, if you see, the liquidity is surplus. We have announced withdrawal of 2,000 rupee notes, and 2,000 rupee notes we have so far got back about 3,43,000 crores, and only about 12,000 crores or so are left. And so 3,43,000 crores we have got back, of which, of course, 87% has come as bank deposits. The rest is, exchange of cash to other denominations across the counter. So there is a substantial amount of, therefore, liquidity which has built up because of withdrawal of rupees 2,000 notes. Government spending is also now picking up. The taxes came around 15th, 20th of last month. Government spending has picked up and will pick up. So therefore, that will also add a lot of liquidity in the system. And I have also said that in the festival season, the demand for currency will go up. So currency in circulation will go up. So that will sort of drain out some amount of liquidity. But overall, if you look at it, the liquidity continues. Liquidity is in surplus. So we have to be very watchful. That's why I have said we have to be active There will be active liquidity management. We will be very watchful. The whole liquidity matrix has several moving parts. We will remain watchful, and we will undertake whatever operations are required from time to time. OMO sales is one which we thought would be required. So therefore, we have made a mention about it in my statement. Thank you.
Thank you, sir. I'll request everyone to stick to one question. Maybe we can come back for a second question. So I'll move on to Ms. Lata Venkatesh from CNBC TV 18.
Is it working? Okay, thanks. So I have to stick to OMO again. When you say OMO intervention, as you say, you have not given us an idea whether you will do an OMO auction or what you have been doing all these days, some quiet screen-based buying. And what is the purpose? Is it that you want to react to the global yields and therefore, some kind of a bulwark? What is your trigger? Has it got anything to do with the way global yields are, 1 full percentage point higher? And more generally, as a EM central banker, what are your fears and what are your tools when you see such a rise in yields?
First point is that this will be done through an auction process and not through the NDS home platform. This will be an auction process. We will notify it, and then we will undertake the auction. We will undertake the operation. That is the first part. And with regard to global bond yields, our liquidity management, what I have announced, has again, let me reiterate, has nothing to do with the global bond yields. If you see the statement carefully, what we have said is that our liquidity management will be consistent with our monetary policy stance. So it will be consistent with the domestic, the monetary policy stance in the context of the overall liquidity situation. So it has got nothing to do with the bond yields going up in the advanced economies. And what was the other part you asked?
General observation, when, it is the international currency, reserve currency for now, and when yields go up there, as a EM central banker, what are your fears? What are your tools?
No, you see, our bond yields, domestic bond yields are reacting to domestic factors. Our domestic bond yields are not really reacting to international factors like the bond yields going up in some advanced economies. Our bond yields are determined primarily by domestic factors as it stands today. The bond yields going up elsewhere, especially in the United States, do normally lead to currency depreciation in the emerging market economies. But the difference in the context of India is that our forex reserves are sizable, very comfortable. So that gives a lot of confidence to the market. And secondly, we do intervene in the market to maintain stability of the currency and to prevent excessive volatility. So primarily, if I can put it differently, we use one bird to kill one. We use one stone to kill one bird. Of course, to kill a bird is not the right thing to say in the context of the safety of animals, but this is a manner of speaking. So I am not saying that we'll go and kill a bird. So please don't take it other way, especially the animal lovers and the bird lovers among you. But on a serious note, we use one instrument for one target, for one objective. When you use an instrument, it may have some collateral impact elsewhere. So that is how it stands. So basically, we will use one stone to kill one bird. Sorry?
Remittances are falling. 1 billion a quarter, they are falling.
Remittances are remaining quite robust. Remittances are remaining quite robust and quite steady. Temporarily, it may happen, but our data shows that they are holding quite comparable to last year. Would you like to supplement?
Our balance of payments for the first quarter shows very strong remittances. In fact, this year might be higher than the year gone by.
I think, Lata, will move on from here. We'll come back to you later on. Let's now go to Swati Bhatt Shete from Thomson Reuters.
Thank you, sir. I'm going to stick to the liquidity theme, sir. So, do you think there's a need for the RBI to rework the liquidity framework? I mean, under the existing framework, the 14-day VRR and VRRR is the primary auction. There isn't active participation seen or as much adequate participation as RBI would like. Now that that's happening, you've had to use innovative tools like ICRR. And now that liquidity is going to remain the key theme, and under the current framework, the call rate needs to be aligned with the repo rate. And you yourself said in today's statement that it's more towards the MSF. Is there a need to rethink this framework, and are you going to actively pursue anything to bring the call rates and overnight money market rates back to the repo rate? Thank you.
I think I would request DG Michael Patra to reply to that.
I think the liquidity management framework is robust. The ICRR was not a reaction to low subscriptions in the regular auctions. It was an instrument intended to deal with a specific occurrence, that is the 2,000 rupee notes. The regular operations are essentially intended to enable banks to maintain their reserve requirement cycles.
So, but, getting the overnight rates back to repo, is that something that you're going to actively pursue? Because that's, as per the current framework, that's required, right? I mean, it needs to be anchored to the repo, and
Yes.
we are already close to MSF.
Yes.
Or you've done an effective rate hike.
No,
So
if
what
you
is
see
it?
on a daily basis, the call money rate is around 6.75. But if you average it for the month, it's 6.56, which is at the repo.
So, thank you, sirs. I'll move on to Mr. Govardhan Rangan from Economic Times to ask his question.
Thank you. So good afternoon, Governor. You actually manage liquidity as and when required. You intervene in the currency markets as well. And now you spoke about the OMO as well, right? So it's a kind of active management of many moving parts. So now, since your announcement of OMO and the financial conditions are not as tight as it is in the rest of the world, if one looks at the a 10-year yield gap between the US 10-year and it used to be 500 basis points on average, but now it's some 220, 225. Is it a kind of a RBI facing kind of an impossible trinity kind of a situation now, in the sense trying to manage all the three, your monetary policy, exchange rate, and flows, everything? Thank you.
No, I think as I